Right. Welcome everybody to the big, beautiful webinar. We're excited to bring you this content. Before I kick off here, I've got two panelists on with me. Richard Goolsby, who is a senior tax manager from the Mariner tax team. I know a lot of clients have already got a chance to meet Richard. And we also have Ben Held, who's a tax manager with Mariner as well. So thank you, Richard and Ben, for joining us. I'll take this opportunity also just to, say thank you for all the great work you've been doing. We've had some really, excellent outcomes for clients, this past tax season and preparing for the upcoming tax season. And that'll be the end of my shameless plug for our integrated, tax services at this point. But without further ado, let's kick this off. So we've got, our disclosures to keep all the attorneys happy. And then we'll get, into the bill. So the One Big Beautiful Bill Act, or the OBBBA, was signed into law on Independence Day, July 4th, 2025. The big picture is this extended primarily the Tax Cuts and Jobs Act from 2017 to the first Trump administration, and resolved a lot of speculation around what, was going to happen with all those TCJA provisions. And it made a lot of those TCJAs permanent. The tax brackets themselves, the standard deduction, qualified business income, which is huge for business owners, and then the gift and estate tax threshold. So we're going to walk through, each of these components, but that's just kind of the high level overview. I'd be remiss, if we didn't touch on the debt and fiscal impact. This bill is, certainly expensive. There's been a lot said about the impact on deficit spending. That is a webinar for another day. That will not be the content for the current webinar. I will make one comment though, despite, when people talk about debt and fiscal impact, a lot of times they reference debt, deficits as a share of GDP. I've always thought that was kind of weird because it's almost like comparing a balance sheet and a profit and loss, your debt to GDP. I think if you look at, wealth, right? Sort of the growth of wealth, private wealth in the country, that's probably a better comparison when you're trying to, evaluate, is the debt, creating wealth or is it not? GDP, I don't think is the right measure, ultimately, but it is expensive nonetheless. And so, we will revisit this topic over time. All right, so let's get into the major provisions. So individuals and families and workers really, got some significant benefit, out of the OBBBA. Or the Big Beautiful Bill. So we talked about the tax rates being permanent. We'll spend some more time there. Standard deduction, was increased back, in the original one. That was also made permanent. Child tax credit, made permanent and increased to $2,200. And QBI, of course, made permanent with a higher phase out limit. So, business owners will get a larger deduction as their income goes up. And then a big one, especially on the coasts, that people have been talking about is the increased SALT deduction, right? So we used to be able to deduct all of our state and local taxes. So like property tax, the income tax you pay at the state level on your wages, that got capped at $10,000 with the Tax Cuts and Jobs Act, which resulted in many more people, taking a standard deduction and not itemizing. Expect a reversal, to that, coming into this year and beyond. There is a phase out though, right? So you don't get the full 40,000 once you get past 500,000. We'll spend some more time on this in a moment, but that is a very key number to keep an eye on, throughout the year and when we're doing our year-end tax planning, to make sure we're getting the full benefit from the SALT deduction. There was also some, really new stuff, things that, Trump had campaigned on and some other things that he didn't necessarily campaign on. No tax on tips. Right. So that's for the next 3 years, right? 25, 26, or I guess 4 years, 27 and 28. No tax on overtime. Now, it's not exactly no tax on tips and no tax on overtime. There is a limit, to what you can write off, but that's certainly what they called it. There's this enhanced senior deduction, which is huge for both itemizers and standard deduction takers, 6,000, potentially as much as 12,000, but also phasing out. And then a really interesting one is the charitable contributions, which is, 1,000, deduction for a single file or 2,000 for joint, and you don't need to itemize for it. So, if you're giving to charity and you weren't itemizing before, you weren't getting any benefit from it, at least from a tax perspective. That's changing, which is great. And then, of course, auto loan interest, that's up to 10,000. There's a lot of caveats, to this, especially around it being a new car and being manufactured in the U.S. But this hopefully is a buoy to U.S. Auto manufacturing and people who are looking to buy new cars. So we're going to kind of peel each one of these back as we go through. I've popped up here the tax brackets, right? So, ostensibly they're not changing all that much. You'll see the green sections. Really it's that like 12 to 22% bracket that's seeing a difference, right? So you're at a 10% tax bracket on slightly more than you were, right? And then the 12%, and 22 threshold slightly higher. It's really not worth writing home about, all that much. But they're made permanent. Standard deduction is also permanent and going up, right? So we were, at 15,000. We're going to 15,750. If you're, head of household, 22,500 and 23,625. And then for married filing jointly, 30,000 last proposed for this year, 31,500 going forward. So pretty straightforward stuff. This is a little bit more interesting. This is the deduction for seniors. So, Trump ran on no tax on Social Security. We did not get that. I've definitely heard him, say that we did and like interviews since that bill got passed. And I think this is what he's referencing, which isn't exact math, but that's, not what the administration is exactly known for, a la the tariff announcement. But what we're getting is $6,000 of additional deduction for people who are over 65. So conceivably, if you're married, filing jointly, right, and you take a standard deduction, you'd be looking at 31,500 a standard deduction plus 3,200 for being over 65 plus the 12,000. That gets you 46,700 of standard deduction. I mean, that is it's a massive number. And so, I'll allude to this, a little bit more as we get closer to the end of the presentation, but, I am expecting a wave of tax refunds, like a record-setting tax refunds in the, first and second quarter of next year, as people sort of realize what this impact is, which should be stimulative for the broader economy, but I'll be interesting to see just how big it really is. I think it's also worth noting, I was talking to Richard and Ben about this earlier, the way that we're interpreting the way that the bill is written, that $6,000 deduction is available whether you itemize or you take a standard deduction. So it's a below the line deduction. It looks like they're going to have a new line item on the 1040 on the tax return below the line where you would claim it, whether you're itemizing or not. And so we have to see what the actual form looks like when it gets published to like make sure. But it's a big deal for people over 65. It's not tax-free Social Security, right? But it is a big deal. The other thing we want to watch out here for is there's a phase out, right? So if you're single, modified adjusted gross income, you get phased out between 75,000 and 175,000 of income, right? So that means that 12,000 is going to go down, right? As you hit those bands. For married, it's 150 to 250. And so one of the planning opportunities, especially for people 65 or older, that we look at, pretty much annually is Roth conversions. This adds a new wrinkle to that math, right? To say how much should we be converting, right? Or how much are we getting back in this, this deduction? Do we want to convert less to take advantage of the full amount? And that's going to be sort of a math, puzzle that we need to work through. But huge benefit for seniors. Now we've got the SALT, right? So this is what everybody's been pretty excited about. This one's kind of interesting. It's the only group of filers that don't get this $40,000 limit is married filing separately, right? So single filers, they've got 40,000 limit. Head of household, 40,000 limit. Married filing jointly, $40,000 limit, right? It's only married filing separately. And so usually we would do a married filing separately, sort of status if people were, trying to achieve loan forgiveness through the old public service loan forgiveness program or any of the other income-driven, programs to say, hey, let's put one spouse on one return and one spouse on the other, and hopefully they'll get a better payment regime. Well, they did away at the Department of Education with the ability to do that. So the married filing jointly thing sort of like came off the table for most practical application. But now it's even more sort of pernicious because you're going to be at this $20,000 SALT deduction versus 40. So for people who are on the fence about, filing separately, if it was for student loan, reasons, it's even more likely that you're not going to get a benefit by filing separately. But for single filers, this is huge, to be able to have, 40,000 of SALT deduction, especially on people living on the coast with, high income and high property taxes. Um, SALT, just for posterity, is state and local taxes, right? So that's your, property tax on your house, potentially on a vehicle, and the wages that you earn, or retirement distributions that you're taking that are taxed at the state level. We mentioned this before. The phase out is 500,000 of MAGI. So if you get above 500,000 of income, it starts to step down. And between 500 and 600, it doesn't get eliminated completely, but your itemized deduction would drop to 10,000. That's sort of the floor. And again, for married filing separately, the phase out starts at 250 and it drops to 5. So like, even less likely use case for married filing separately as a strategy, on a go forward basis. I said this before, I'll say it again. A lot of folks have not baked into their withholding, their W-2 withholding, or the, tax withholding on the retirement distributions, the fact that they're probably picking up, as much as a $30,000 deduction that they didn't have in the prior year. And so this is a great opportunity to, towards the end of the year, third quarter, fourth quarter, pull the pay stubs, run some projections, really see where we're at. So that, if we have the ability to reduce our withholding through the end of the year, get some extra, money through the paychecks, or reduce the amount of retirement distributions accordingly, that could be a real win. So something that, everybody should be keeping an eye on, and we have the capacity and capabilities to help you do that. So please reach out and we'll be happy to crunch some numbers with you. All right. So, jumping ahead from the SALT deduction, they put an inflation adjustment on it. So, this is first year, right? 2026, it goes up 40,400, 2027, 4,804, then 41. And then in 2030, it goes back to 10, right? And so, this is, clearly a window of time, to take advantage of that benefit. And like one thing to think about is with charitable contributions, right? So we mentioned before, there's a new deduction for 1,000 to 2,000 of charitable deductions if you do not itemize. If we get back to 2030 and all of a sudden our state and local taxes are back at 10,000, a lot of people who were itemizing, they're going to go back to that standard deduction. And if you are philanthropic and that is part of your plan and you plan to give, right, we have this window of time where chances are you're going to be itemizing because you've got a much higher state and local tax, deduction that's going to exceed the standard deduction. And you can probably get the full benefit of your charitable contributions during that window of time. So if philanthropy is part of your plan, if we have appreciated stock, that we can put into a donor advised fund, if we're using, things like, charitable remainder trusts or private foundations, this is a important window of time to, really try to make the most of it. And, Ben, Richard, stop me if there's anything I'm missing or that you want to add.
I'd say something small to consider is, with those state and local taxes, if you're not maxing out that 40K and you need to, in the next 5 years, buy a vehicle or something like that, don't wait until 2030, use that sales tax, which is not going to be a huge thing, but, get it as close as you can to that upper limit. And don't forget that you can add things like I bought a large appliance and I paid sales tax on my fridge or my couch or my vehicle that I purchased, and that all goes into that equation as well.
Yeah, that's a really good reminder. Like for record keeping purposes, for the past couple of years, it probably didn't make, a lot of sense to keep those receipts.
Mhm.
But now it really does. So any big ticket purchase you make that you've got sales tax on, hang on to that receipt, put it in the tax file, make sure you get it to the preparer, to include. That's a great point. Um, so, other changes to itemized deductions, right? So, the mortgage interest limit, right, of 750,000, this is not changing. So what this means is if you have a mortgage that's more than 750,000, that doesn't mean you can't write the interest off. You can, right? But only up to 750,000 of the total mortgage debt, right? So this used to be like a million plus 100,000 for improvements on like a home equity loan. It's still 750. However, mortgage insurance premiums, or PMI, are now deductible as an itemized deduction starting not this year, but next year. I think this is a really positive thing for like a whole generation of millennials that, have gotten squeezed a number of times. by the broader financial markets, but in particular with like the home prices and COVID and everything else. Like if you're previously we couldn't deduct our mortgage interest, right? And so if you put 3.5% down on like an FHA loan, or you put 5% down or 10% down because the constraints of just the prices that you're paying are so high, that was really painful. But if it's deductible now, and now all of a sudden you've got mortgage interest to deduct, and now you've got property taxes to deduct, right? You're probably going to be itemizing, and that mortgage interest is going to be deductible too. And so I think this is going to, if you're considering buying a house, and again in 2026 is when this kicks off. A lot of times people will roll the mortgage interest into the loan, lender paid MI. Um, it's unclear if that's going to have any, sort of tax benefit, whereas like normal mortgage interest premiums, which will show up, on your 1098 form typically, will be deductible. And so that's something to keep an eye on for people who are either planning to buy houses or if you have children who aspire to buy homes. This is not an insignificant thing. The other one that's really important is this charitable contribution floor. So this doesn't start this year. This starts next year in 2026, which makes this year even more important. The way it works is there's a floor for what you can write off. And so for people who are familiar with the medical deduction, right, you can write off medical expenses, but only that, that's above 10% of your AGI, right? And correct me if I'm wrong, Ben and Richard, is 10% of AGI for medical expenses?
7.5.
7.5. Okay. So if your AGI is $100,000, right, the first 7,500 of medical expenses you don't get to write off, right? But anything beyond that you could. Using that same example, right, with the charitable contributions, right, the first 0.5%, right, or in this case $500 on 100,000 wouldn't be deductible, right? But anything beyond that would. So if you're a high income person, and let's say you're making, $1 million a year, or something like that, but you're also giving to charity, right? That floor is going to be pretty high.
Mhm.
Um, it's, what is that? Yeah, for the first 5,000, right? You don't get to write off. And so if you plan to be philanthropic and you're in a high income tax bracket, this is not effective for this year, for 2025. It only begins in 2026. So we're encouraging clients that do have a philanthropic intent to consider accelerating contributions to charity this year, either in earnest directly to charity or through things like donor advised funds, which we'll talk more about here in a moment. I got a question on PMI that popped up. Is the PMI deduction when the house goes into circulation, or can it be before 2026? That's a good question. I don't know that off the top of my head. I'll jot it down and I'll get back to you with an answer. But excellent question, Ben and Richard. I don't know if you guys know the answer to that, but retroactive PMI to homes placed in service prior to 2026.
I think it'd be based on what's on your 1098.
So that would include it would include prior. Yeah, that'd be very
Yeah.
difficult for the IRS to track, right? If you
Yeah.
kind of think about it. So we'll get a dive and we'll answer and I'll follow up. A good question. Um, the other thing with charitable contributions is there's a new ordering limit, right? Where effectively there's a 60% limit on cash contributions, but that amount is going to be reduced by the amount of capital gain property that was also contributed to charities in that current year. So, starting in 2026, like philanthropic gifting, we're going to want to put a sort of fine tooth comb to and make sure that we, fully have a good handle on how much is going as cash versus how much is going as stock. And just, these are new things to keep an eye on and just make sure, you're on the ball for. And then, there's a couple other ones. I think that the one that kind of stands out that I don't have a bullet point on is there's an overall itemized deduction limit starting next year. And so this only affects people in the 37% tax bracket. So like the highest income earners. It's this 2 and 37 rule. The math on this is a little bit tricky. I read like 3 articles and it's still kind of, difficult to wrap your head around. But the key point is, if you are a high income earner, and let's say, for instance, you're using something like investment interest expense, right? Which, like on a securities backed line of credit or something like that is like one of your primary deductions. You may have an impact on how much is actually deductible, which is going to have, important planning implications for, very high income people. And so we talked about this a little bit before, but the planning opportunity, going back to charitable contributions, we call it bunching, charitable bunching. And so with the donor advised fund, you're able to make a contribution and take the tax deduction in the year that the money goes in. Ideally, this is done with appreciated stock because when the stock goes in, you don't pay capital gains. It just goes away. Um, but if you say, made $5,000 of charitable contributions a year, right? You wanted to take advantage of this, charitable floor or higher, itemized deduction, SALT limitation. You might say, hey, let me do 5 years worth of my gifting now, right? And put $25,000 into a donor advised fund. Take the full deduction for it, right? And then just pull the money from that donor advised fund to make your gifts over the next, couple of years. Um, so I'm encouraging clients to think about between now and 2030 as, make the charitable contributions that you intend to give out between 2030 and 2040 so you can take advantage of it today, right? From a tax perspective, that is. So, there's certainly an opportunity there that we want to keep an eye on. All right, moving along. I want to get into the new below the line deductions, right? So these are available for both itemizers and standard deduction takers, right? This you could do either one, and these are still available. All right. The first step is that senior deduction, right? If you're 65 or older, we're looking at 6 to 12,000, but watch out for that AGI phase out, right? The next is tips, right? So it's not tax-free tips, right? It's up to $25,000 is what you can write off. Qualified overtime, right? Same thing, 25,000 for joint filers, 1250 for others. And then auto loan interest of up to $10,000. Now, if you're a business owner and own your automobile through your business, there's no limit to your automobile interest deduction, assuming that it's 100% business use. You'll write it all off. But for regular non-business owners, a $10,000 deduction on, we know what car prices have done in recent years, that could make a pretty good difference. Now, the auto loan deduction, it's only on new cars, right? So it can't be a used car, and it has to be manufactured in the U.S., right? So that's going to narrow this, list of potential, purchases. However, if you're a fan of, American automobiles and you're in the market for a new car, this is effective 2025, right? So, this year. We talked about charitable contributions, 1,000 and 2,000, for non-itemizers. These have phase outs, as most things typically do based on income. And they're in effect for a fairly short period of time, right? 2025 to 2028. But tips and overtime, they start to phase out, $100, of deduction is reduced for every $1,000 over 150 if you're single, or 300 if you're a joint filer. Auto loans, same thing, 100,000 if you're single, 200,000 if you're joint. So we've got to watch these AGI ranges pretty carefully for these very specific, 2025 to 2028 deductions. And there's all sorts of tips and tricks, that we can do to try to reduce AGI when possible. So this is a good visual of sort of what we were, talking about. You got above the line and below the line deductions, right? So before your adjusted gross income, and again, like a lot of these limits that we're looking at are based on your adjusted gross income. So these are things that help trim it down. And then below the line, right? So we still have capital losses, right? So up to $3,000, educator expenses, 300 to 600 married filing jointly, HSA contributions, IRA contributions, student loan interest, 50% for your percent of your self-employment tax if you're self-employed. Moving self-employed health insurance is still there. Moving expenses for armed forces, and then other Schedule One. Off the top of your head, guys, what are some of the other Schedule One adjustments that would fall in that group?
If you have a loss from your business activities, that would go there. We don't see a lot outside of those that you've already listed commonly on Schedule One that I can think of off the top of my head. You've got a pretty good list there.
So if you have if you're self-employed or you've got a farm or whatever, would this include rental
That's right.
activity? Yeah, so
That goes on Schedule One.
rental, business, farm, all that activity. If you're passing a loss through, right, that's going to reduce your AGI above the line, right? Which again, all these brackets that we're talking about, 250, 100, things start to get phased out. Those are the things that will make a difference. Now below the line, right, we still have standard itemized deductions and, QBI, qualified business income. That's for people who are business owners that, can effectively, it gets phased out, but you can write off 20% of your net income. And for those that are curious, this QBI deduction, the reason this exists is because they took the corporate tax rate down in the Tax Cuts and Jobs Act. And so they needed to do something to normalize that for small businesses that weren't C corporations. This was the mechanism that they used. And then we got the new ones, right? Seniors age 65 and over, 6,000, charitable contributions for non-itemizers, tips, overtime, car loan interest, right? So those are the big new ones to be thinking about and keeping an eye on and keeping your records orderly for when you get ready to file your taxes. Okay, AMT. So alternative minimum tax does not, in the past couple of years, does not impact that many people, right? It really impacts people that have incentive stock options or ISOs. However, with a larger itemized deduction, right, this could become more of a going concern for folks. This is what we're sort of referring to as the bump zone, right? And so for single filers and for married filers, there's this little area of income, right? For single filers, it's between 500 and 650, and for married filing generally, it's between like $1 million and $1.3 million. Where your tax rate, your marginal tax rate gets bumped up significantly, right? So from call it 30% to 40, in those two little ranges. If you have, AMT, pretty much if you have a lot of incentive stock options. So that's a very careful place to watch. And so it's we don't see incentive stock options as often anymore. Usually you see, restricted stock units and unqualified stock options and things of that nature. But if you do have them, this goes into effect in 2026. It is not in effect for 2025. So if you have ISOs, if you know anybody that has incentive stock options, if you catch a whiff of an incentive stock option walking down the street, focus in on this. This is a big deal. You're going to want to, do some real number crunching and some, real planning around exercising those ISOs this year, ideally. So sort of a narrow use case, but for people that it matters for, it really, really matters.
I think just to tack onto that, you sort of mentioned itemized deductions, but just remember state and local taxes are an add back to AMTI, which is alternative minimum tax income. So that's going to also hurt once you get up to that. If you are taking that $40,000 state and local tax deduction, now you're going to have a $40,000 add back to your AMTI. So that could also negatively affect folks that have ISOs and things like that. So,
yeah, no doubt. The state and local taxes going up. I mean, that's where people would get tripped up in the past before 2017 is they had a boatload of state and local taxes. And so
PTEs are still a workaround. So don't forget about PTEs. They are not an add back.
Talk a little bit more about the PTE, if you don't mind.
Yeah, pass-through entity tax payments. It's essentially where you can take a deduction. If you have a business, you got a partnership and you have positive net income, obviously, on that. And it's different per state, but there are set percentages that you can say, okay, if I'm in California, I'm paying 9.3% of my net income from my business. And I'm actually going to take that as a deduction on my business return. And what's going to happen is I'm going to get a credit that flows through on the K-1 for state taxes paid on the entity level. So I'm actually taking the deduction instead of needing to carry it to my itemized deductions, as I usually would. I'm actually just going to deduct it right now on my entity, and then I get a credit and it flows through on the state income tax return as a credit for state taxes paid. So, and again, it doesn't add back to AMTI, so it's a great workaround for folks that have that as a concern.
Yeah, and this was even more prevalent in the past couple of years after TCJA because the state and local tax limit was $10,000, right? So if you can run it through the entity, you can still get the benefit from it, like Richard said. So yeah, great point. Thank you for that. Okay, new investment account alert. We've got the Trump account.
Sam, can I chime in for that too?
Yeah.
For the PTET, remember that also will reduce your AGI. So those AGI limitations that also come into play, like your charitable half floor and stuff like that in medical, that's also a big play as well.
Yeah, and above the line deductions, Schedule 1. Yeah, absolutely. Right. So if we're trying to trying to play the AGI limits for the senior deduction or for, the phase out on itemized deductions or any of these other things, auto loan interest, right? That's a very good point. It's an above the line. It's going to reduce AGI. Thank you, Ben.
Yep.
All right. So the Trump account, right? This is a brand new type of account. I was talking to one of my, let's say liberal colleagues at the Financial Planning Association, and he was belaboring how he would be saying Trump account for the rest of his life. But unfortunately, that is the case. This is a brand new type of investment account. We'll touch on some of the highlights. So between, you have to have a Social Security number essentially, right, to open one of these up, which means, child needs to be born. If they're born between 2025 and 2027, Donald Trump himself, no, I'm just joking. The U.S. government is going to put $1,000 into these accounts, right? So if you got a baby on the way and bills to pay, you've got $1,000 coming from the federal government into this account. Now you can't use it to pay your bills, but you will get a contribution. These are opening up July of next year, July of 2026. Contributions can be made, between birth and age, 17. And that limit is 5,000. They do have an inflation, index on it, so that's going to change over time. It's limited with the investments that it goes into. It's limited to U.S. equity indexes, so like broad market indexes, no sector specific funds, and it's got to be super duper inexpensive. So like think Vanguard, right, is where like these things are probably going to primarily exist, or we're going to have fund companies coming up with new products that are S&P 500, Russell 3000, so on and so forth. But it's U.S. based investment. I got a question from the crew. Should I fund a Roth IRA first, or is this new type of account? Can I do both? What is the limit? So fortunately, these contributions will not impact any other type of retirement account contribution that you would otherwise, or the child would otherwise be able to make, right? So if your child has earned income, they could still make a Roth contribution. You could still make a Roth contribution, and you could contribute to the Trump account. There's no overlap in that sense. So good question. You don't have to choose. Like if the cash flow is there or the assets are there to make the contributions, you can still do it all, so to speak. It's not a deductible contribution, right? In the sense of like a traditional IRA is deductible, right? So you don't get to write it off. But once it goes in there, right, it's got very similar treatment, to a traditional IRA. You can't take any money out, while the child is prior to age 18. But when they turn 18, distributions are allowed. The caveat is they're treated very much like IRAs, right? So they're subject to early withdrawal penalties before age 59 and a half. The contributions can be taken out tax-free, but any growth, right, is going to be taxable. So very much, like a non-qualified annuity, right, where your sort of your basis is return of principal, but your appreciation you're going to pay ordinary income tax on. Also at age 18, you can use whatever investment you want that's allowed in an IRA. It doesn't have to be the U.S. stock, 5 basis or 1 basis point, type investment. Another key piece is that they will not be aggregated with other IRAs for distribution rules, and where this makes an important planning caveat. The aggregation rules we always run into when we're doing backdoor Roth IRAs, right? So if you have a traditional IRA and your income is too high to make a Roth contribution, you end up in a sort of a problem if you try to do a backdoor Roth. And I'll use easy math on this. Let's just say, and just taking a quick step back, the backdoor Roth is you can make regardless of your income, you can make an after-tax IRA contribution of $7,000 this year, $8,000 if you're over 50. That's an after-tax contribution. You take one more step, which is a Roth conversion. There's no income limit for Roth conversions. The gotcha is that, let's just say, again, for easy math, you've got a $7,000 contribution to a non-deductible IRA, but you've got $93,000 of traditional IRA money, maybe you rolled over from a former employer over here. Well, the IRS goes, hold on, you've got a total of $100,000 of IRA money and 93% of it's never been taxed. So when you go to do that second step, that Roth conversion of that $7,000, 93% of that 7,000 is now taxable income. And so that's why typically we'll try to get IRAs into an employer plan like a 401k or a solo 401k or something along those lines, so we can do backdoor Roths. But this will, these accounts will not impact the ability to do that. Another question. So this is not really an account that would make sense to use as a college fund, since there would be penalties for withdrawing at college age. Yeah, I agree with that statement. I still think you're going to want to look at Roth IRAs, right? Because you can take out both your contributions and the earnings penalty-free and interest-free, or tax-free and penalty-free, for qualified higher education expenses. The same is true with the 529, obviously. And then you've got overfunded insurance policies, maximum, funded, mutually owned, non-MEC whole life insurance, which you can borrow from tax-free and penalty-free for any reason at any point. And Roth and life insurance don't show up on FAFSA if you're looking for needs-based tuition, support. So no, I don't think that this this is not meant to be a college savings account. This is meant to be a retirement account, for a child. I would still favor a Roth over this if we could get earned income for a child. You can't contribute to a Roth IRA unless you have earned income, and unless your child is working, in earnest. It's very hard to get a child earned income unless the parent is a business owner and they can compensate them for work they did in the business or their name, image, and likeness. In those cases, you can get earned income for a child, but it's difficult to do otherwise.
I think it's a little broader. It's nice that it's a bit broader than what you can do with a 529. You're not getting the deduction on the state level, which is a bummer, and it doesn't grow tax-free. But the qualified withdrawals are not, which are taxed at capital gains rates, which is nice. It's not ordinary income tax rates. Can be used for other things like a small business loan or a first-time home purchase. So you got a little bit more broad of a scope of what you can do with them as far as a qualified withdrawal goes.
Yeah,
I think it's worth considering.
And candidly, I've got to get deeper on these Trump accounts to figure out exactly how they tick. This is all brand new, but I did hear from one of our clients in the chat who's a expert on some of the legislative stuff. Housing is also a qualified expense on these accounts, so it could be useful there. So as we get more info on how these things really work leading up to July of 2026 when they come online, we'll make sure we publish some additional resources. But the Trump account is here, and not going anywhere. And yeah, there's going to be like a 3-year window of babies to get $1,000 in their Trump accounts that'll compound at XYZ%. Yeah, Ben is going to have a baby that will have a Trump account. A lot of our clients will, and yeah, compound that at high single digits for however many years, and that's not an insignificant sum. So fascinating stuff. But so kicking forward a bit, estate and 529 plan changes. So estate tax exemption, made permanent at the higher level. 2026, it's jumping up to 15 million, and with a permanent, adjustment for inflation. And so what that means is at the federal level, not the state level, but at the federal level, you have to pass away with, over $30 million to pay estate taxes, which is clearly a significant sum. Ben, I think I saw something on the chat. Did you?
Yeah, I just wanted to tell John on his question regarding the mortgage premiums. I've been doing some light research on the backside here, and there's very limited phase out ranges and stuff. It looks like there's going to be a phase out on it. They just haven't really came out with the exact figure yet on it. So stay tuned.
Okay. Any of the other ones you wanted to chime in on before I move forward to 529s?
I don't think so.
Okay.
Again, Trump accounts, light reading on the backside here too. There's not much verbiage on them yet as well, since they're brand new.
Okay. All right. Okay, so let's get into 529s. So they expanded eligible expenses for K through 12, and this is effective as of the time the bill was signed, July 4th of this year. So previously, just to take a step back, for K through 12, you were limited to $10,000 of distribution from a 529 to cover tuition and, sort of a limited set of expenses. But that's been expanded to curriculum materials like textbooks and online stuff, tutoring with, qualified tutors outside of the home, standardized test prep, AP exams, college admission tests are all, eligible now. Dual enrollment fees, which I'm not entirely sure what that pertains to. So maybe somebody who's, familiar with that can chime in. And then if educational therapy for students with disabilities, which is big because previously ABLE accounts were sort of the vehicle you would use for these, but 529s you can also use too and leverage. And the limit itself is also going way up. It's doubling. So that's effective in 2026. But for our clients that have children in private school where they're writing significant checks, and we're looking for a way to get money at least at the state tax level to be deductible. That's a big benefit. Like in Virginia with two 529 plans with two parents and one child, you can get $16,000 of state tax deductible contribution in, and you couldn't pull it all back out previously. It was only limited to 10. Now you can get all of it back out. So if you're going to pay the 16,000 anyhow, you might as well get a state income tax deduction along the way for doing it, which Virginia is 5.75%. They're also going to be eligible for post-secondary credentials. So like industry recognized certs, so like if you're taking like the PMP, or something along those lines, CPA, CFP, and professional, renewal, professional licensing programs, so anything that's like recognized in your industry is going to be eligible for 529s as well. All right, now this one's kind of a bummer for the clean energy, industry, but clean energy credits are being repealed, essentially writ large. The termination dates that were originally set are being accelerated and much sooner. And the big takeaway is that, if this is something you're planning to do, go out and do it. The ones that end, sort of immediately or sooner than the others, the new clean vehicle credit of up to $7,500, that's terminating September 30th. Used clean vehicle also September 30th, $4,000 credit. Then we've got December 31st of this year, the home energy efficiency. So like Richard and Ben, this would be like insulation, heat pump, windows, what else?
HVAC, doors,
Front door, yeah.
all that stuff.
So that's December 31st of this year. And then the big clean energy credit, which like mostly this is solar, able to take a 30% of what you paid, take that as a credit, not a deduction, but a dollar for dollar reduction in the taxes that you owe. That's sunsetting December 31st of this year as well. There's one that's hanging out for a little bit. That's EV charging equipment. And that's going to be June 30th of next year, right? That credit is going to go away. So if you are planning to do any of this, and it makes sense and the price is right and, so on and so forth, this is your chance to get some additional benefit from it, before it gets phased out.
Don't buy your Tesla if you make over 300K because you're not going to get a credit for it. So.
Yeah, there's an income phase out you got to think about too, right?
And I think it's important to note for the home energy efficiency credit, it's when the asset goes into use. So you can't, buy on December 31st, go ahead and pay the guy that's going to come install the thing. It needs to be installed and in use by the phase out date. So it's important to note.
So don't like give insulation for Christmas and or a new door. Get it done sooner than later. All right, so that's clean energy. For our business owners, we talked about QBI. The long story short is it's still here. It's still 20%. But the big difference is that the phase out has a sort of a more gentle slope, right? So as your income rises, you'll be able to take more and more of the deduction than you would have previously. So for our business owners, again, there's income phase outs on all this. In this case, 550 for married filing jointly, 275 for single filers, and then of course, like specified trade and business, the phase out is faster than it otherwise would be. And so, Richard and Ben, briefly on specified trade or business, generally, what are those types of businesses?
Doctors, lawyers,
Consulting.
attorneys, consultants.
The
Uh,
most we see is consultants is the most common one on a Schedule C or something like that.
Financial planners, certified public accountants.
Yep. Yep.
Lawyers. Yep.
Okay. So
Yeah,
those,
pretty much if you don't sell a product like outside of something that's just knowledge based, you
It's it's a reputation based. I mean, essentially the way that they've gone on to define this is that if your business hinges on your reputation as an individual and is inherently linked to you as an individual, then you are an SSTB.
yeah. And this is where, and this has been the case since 2017, but this is where, some business owners will bifurcate their activities, right? So like, take for instance, like an influencer or something like that, that is, specified trade and business on their influencing ad revenue, but they also sell let's say it's a downloadable, um, like, like I don't even know. I do have one client that I'm thinking of where it's like stencils and things you can carve out and do something like that. You might bifurcate that business because one of them is like a physical good where you would get a better, QBI deduction. The other one is not, right? So
yeah,
depending on the nature of your business.
t-shirts and merchandise is a lot of what influencers do to
Yeah,
bifurcate
you
out.
you
So
would house that in a different, theoretically LLC or other entity, so you could get the QBI deduction from that, right? Um, Okay, so other noteworthy provisions, qualified small business stock. So if you own a small business and you're going to sell it, you can avoid taxes on the sale, and that is increasing to 15 million now. Student loans being discharged permanently excluded, from income. Uh, the adoption credit, $5,000 is now the refundable portion of that adoption credit. And then HSAs got expanded where there were some like bronze plans that, maybe they had the right deductible, but they didn't have the right max out of pocket to like, specifically qualify for HSA. They've now said that if it's a bronze or a catastrophic plan, like through the marketplace, that's going to be HSA eligible, which is good. For those who aren't familiar with the HSA, it's like the least used, best investment account in America, triple tax free, tax deductible contribution, tax free growth, tax free distributions for medical expenses. It's not used nearly as much, I think, as it should, by most people, but not right for everybody. If you have a lot of medical expenses, then you do have to couple it with a high deductible health plan, so it might not be a good fit. And then there's some other reporting changes. The 1099 threshold to where you would have to, issue a 1099 for a $600 transaction, that got pushed back to 20,000 or 200 transactions. That's good for a lot of our small business owners. 1099 threshold, at 2,000, then 1% tax now on remittances. So, probably cryptocurrency implications involved in the whole remittance game at this point, especially with the 1% excise.
my little plug on the QSBS is definitely to hold it jointly if possible, because QSBS is by taxpayer basis, so you can actually double the amount of exclusion. Say if you do hit it big on one of those, you can actually get it up to 30 million of exclusion.
Wow. So if you're let's say you're a married, business owner and you own the business, outright, but you're getting ready to sell, having having a spouse also own, let's say, half of the business, right, would take that exclusion from 15 to 30 million. That's huge. That's a
Correct.
great planning tip.
Just
Um,
remember the original stock needs to be issued by a C corporation.
right. It's got to
I
be a
think
C
that's the
corp.
big part. Yeah.
Yeah, QSBS there's a whole webinar just on QSBS for people seeking a liquidity event that maybe we should do in the future. But I want to jump ahead to the business stuff. This is where it gets really interesting, right? So 100% bonus depreciation permanently restored, right? For any property placed in service after January 19th. My clients are going to hear me talk about bonus depreciation a lot. If you're not hip to this, I will bring you up to speed. R&D expense. If you're a business owner and you are doing, true research and development, permanent, 100% expensing for R&D costs incurred in the U.S. Is back, and you can retroactively apply for it, from 21 to 24, and deduct those expenditures from 2025 over 2026. R&D credits are there's a lot of documentation that needs to go into it, but if you think that you are doing like any dyed-in-the-wool research and development, this is a big deal, and it should be taken a close look at. Section 179 expansion. So this is accelerated depreciation, not bonus depreciation, but accelerated depreciation. Increased to $2.5 million. Phased out at 4 million, which is a big deal too. And then we talked about PTET pass through, entity taxes. They did not do away with this, surprisingly. But if you're a business owner and you've got the state and local tax, you can take it at the business level, reduce your AGI, and take the full deduction. There's a carve out for manufacturing and production as well. This one is limited to 2030, and it is new factories and manufacturing facilities. If you're in that zone or in that industry, this is a massive, massive deal. If you're not, it's not. But you're able to essentially write off not only the equipment, but the facility itself in the first year, and that's a massive tax savings for the right person. And then, of course, Opportunity Zone 2.0. We've got, if you're not familiar with Opportunity Zones, these are investments or parcels of land places where if you have a capital gain, it doesn't need to be on real estate. It could be a capital gain on stocks or, on anything. If you take those proceeds and you invest them into an Opportunity Zone and hold it for 10 years, you can avoid the capital gain on the original transaction altogether. It's slightly more nuanced than that, but they're back. And this is a great planning opportunity for people who have potentially large capital gains that they're dealing with. I want to briefly talk about short-term rentals and the opportunity that lies therein. If you make over $150,000 and you have a rental property, you can't write off any losses on your rental property. You get phased out, at that point. However, there's a set of rules pertaining to active and material participation that would allow you to take real estate losses against all of your other income. And so material participation, you have to meet, a couple of different tests. It's 500 hours or more, or your participation was substantially all of the participation in that, in this case, short-term rental, or you put in 100 hours and nobody else participated more than you. So think property manager, cleaners, things like that. That's how you'd achieve material. And then for active participation, active non-passive participation, the average stay would need to be 7 days or less, or you would need to provide extraordinary personal services in making the rental, there's a typo there, property available for customer use. All right. So Ben and Richard, can you speak to that, briefly in terms of, in particular, the extraordinary personal services and like what that test means?
Yeah, it's generally, we think about it like a hotel. And previously, I mean, I've been doing this long enough to where I had, before any of this existed or before Airbnb was around, I had some guys that owned hotels. And it's just, they treat it differently because the intent is single family rentals with a long-term rental lease, right? That you're not actively participating. By definition, you get somebody in, you leave them there for a year, you renew, you renew or you don't, but you're not actively involved in that property. So the IRS says, well, this is per se passive. But when you have an Airbnb or something similar, and you are going in daily, every couple of days, changing the towels, you're changing the bed sheets, you're doing things like that. Well, now you're acting more like a hotel would, and you're actually actively involved in that business. So what it does is it's called significant services, is how the IRS defines that. And it takes you out of that per se passive definition of being a rental real estate owner. And so there's two things that happen. If we provide significant services and we change those towels, we change those sheets, now we're moving from a Schedule E with a rental to a Schedule C. That's the mechanism to move to Schedule C. And from there, the question is, let's say I've got a cost seg done and I got a lot of depreciation, I want to take it. Well, from there, it goes back to what Sam was talking about. Did you have material participation? Because if not, we're going to limit that loss at zero and you carry it forward. So you do the two things. Number one, I'm in a rental property. It's a nightly rental. Average stays under 7 days, and I'm providing significant services. Now we're on a Schedule C. From there, do I have material participation or not, which controls whether or not I can write that loss off against other active income, or do I just have to carry it forward?
Yeah, thank you for that. So the big takeaway here is that, like, typically, right, if you have a rental property, you can't take losses on unless you're a real estate professional, which is a very difficult test to meet, unless you're actually a real estate agent. But in the short-term rental world, right, it's much more achievable. 100 hours a year, like is a lot more, easier to document and legitimately justify. If you have those things, then you can use a cost segregation and bonus depreciation. And so I've got a quick example of this. This is an actual one we did this year. We've redacted the property, but it was a $625,000 purchase. You cannot depreciate land. You can only depreciate the property itself, right? So out of that 625, 522 is the building, 102,000 is the land. And so because the way the bonus depreciation works is when you do a cost segregation study, you break up the property and segregate the costs, right, into its depreciable life. In this case, right, you've got 5-year property, like, vinyl plank flooring is like 7-year property, right? You got the sink, it's got its own depreciable life. But like the walls and the windows and the doors, that's all 27.5-year depreciation. Under bonus depreciation, if it's anything other than 27.5-year depreciation, you can take it all at once as a loss, right? So in this example, if this person was just doing normal depreciation, they'd have a $13,000 write-off on their, in this case, Schedule C. If you do a cost segregation study and then you use bonus depreciation, right, that write-off is $140,666 in this case. And so if you meet that other criteria, right, the active material participation or the sort of short-term rental example, that $140,000 a loss, you can now use to offset all of your other income, right, as an above the line deduction to reduce your AGI. And so, this, if for the right person that's interested in owning real estate as part of their broader plan, this is the single most sort of effective tax strategy, at this point, other than, being incredibly philanthropic or, using a combination of defined contribution and defined benefit plans, retirement accounts, if you're a business owner. So this is something that if you plan to include real estate in your portfolio, this is the way to really make the most of it. And if you want, more information on that, just reach out and we can talk more. So let's
I think just a quick note is that a reason that that's even more attractive is that when I move over to a Schedule C, I've moved over from a 27.5-year life that I'm depreciating this property over. If I don't do that cost seg, everything's at a 39-year life. So I'm really slow tracking depreciation. So it makes it, if you are in that scenario, it really does make it attractive to do that cost seg because otherwise you're stuck depreciating over 39 years instead of 27.5. So you're really slow tracking depreciation there.
Yeah, and I think just the other caveat we'll make on depreciation is when you sell the property, whatever you depreciated comes back as ordinary income. So if you do bonus depreciation on a property, which you might consider when you do go to sell it, is potentially do a 1031 exchange into another, property for business use, or into what's called a Delaware statutory trust, which is instead of like finding a property and buying it, it goes into, for lack of a better word, a REIT, a real estate investment trust that, is, not something that you personally manage. But if you can take the depreciation now, there's a time value of money to, hey, my taxes were $50,000 less and that stayed in my portfolio and grew over that, time frame. It theoretically grew, right? It's something that I think people who are interested in real estate, should absolutely be considering. We had a question come in. Does the 500-hour have to be more than any other hours similar to being a real estate professional? Does the 500 hours have to be more than any other hours similar to being a real estate professional?
No, you get 500, you're there. Doesn't matter who else is doing what on the property. You make your 500 your material.
Yeah, it's 100 and nobody does more than you or 500. Right. Okay, so huge planning opportunity for those who are interested in it. And, one of the nice things about, working with Mariner, I was told there's about 100 people who are licensed to do cost segregation studies in the country. I think 3 of them work for Mariner. And so, if you find a property, send us the address. We can give you a quick estimate of what the tax benefit would be. So critical dates, right? 2025, increased standard deduction, senior deduction goes in place, SALT's up to 40, child tax credit increase, got tips, overtime, and auto, 529 plan, K through 12 expenses are expanded. A lot of clean energy stuff is coming off, and bonus depreciation for properties purchased and placed in service after January 19th, 2025. Richard and Ben and I were joking that somebody in the administration must have purchased a property on January 20th for that specific date. Next year, tax brackets, we get the inflation adjustment to the 10 and 12. All the itemized deduction changes all kind of kick in. The charitable contribution floor of 0.5% AGI. That Section 199A phase-out range increases. So this is is that QBI? QBI, that's right. AMT kicks in, right? So exercise your ISOs. A state tax, threshold, jumps to 15 per person, 30 million for a couple. Trump accounts kick off. EV charging credit drops off, and then 2028, all those, sort of below the line new deductions will be phased out. So, in terms of planning opportunities, right, for this year, charitable contributions, right, avoid that 0.5% of AGI floor, right? So bunching charitable contributions, using appreciated stock, leveraging the donor advised fund. That's a conversation we should have. If you have incentive stock options, or anybody that has incentive stock options, put them in touch. That is some complicated planning that needs to be done and modeled. And we were ready to do that. Clean energy purchases, right? Get them in before the credit expires, and don't wait to the last minute, like Richard said. And then the short-term rentals, purchase after 1/19. We now have this bonus depreciation, which was set to sunset this year, back at 100% and permanent, which is a tremendous tax planning opportunity for the right person who is interested in owning real estate. And then ongoing, right? Mark my words, we're going to have record refunds, in Q1 and Q2 of next year. And I think it's going to be highly stimulative for the economy. It's probably going to bump inflation up a little bit. But you don't need to be in that group, right? A refund is not always a good thing, right? It means you lent money to the IRS for some period of time. So we can adjust your withholding based on all the new rules so that you're getting more money per paycheck back, to either invest or to use or to, mitigate a risk or capture an opportunity, you name it. Roth conversions, we got to watch out for those phase out limits, as the age, 65 plus, the AGI, base one, the QBI ones, right? That's going to be a more important thing. SALT planning, maximizing the deduction between now and 29. Same with senior deductions, taking advantage of the 529, expenses. And then of course the short-term rentals, continues, over time. So with that, I'll take this opportunity to thank all of our clients who came, to the webinar, and especially to those who participated with questions. Thank you for your business, and more importantly, your trust. Also, Ben and Richard, thank you for joining us. Thank you for all the hard work you've been doing. It's been a real joy to work with you guys, and the outcomes, have been great. So thank you very much for your help. If you have any questions about the material in this workshop, or you want to engage with the Mariner tax team, or you just want to chat, give me a shout. My contact information is there. And I'll stick around. If anybody has any questions, use it there's a chat feature, Q&A feature, excuse me, where you can type a question and we'll hang out for another minute if anybody has any. But thank you very much for joining us for the big, beautiful webinar.